when the massive refining engine that is China stops or mitigates or really puts a wall up against exporting out into the market, you're starting to see the reverberations. And I'll tell you this, because of tariff threats, the 100-ounce bar and the kilo bar market in this country has become incredibly scarce with really high premiums because the threat of tariffs made it so that the large importers who bring these bars in were afraid to do so. And all of a sudden you have a market that is really, really short on investment grade bars in North America, and it's getting worse.
There is a growing dislocation in the global silver market that most investors still do not fully grasp, and the early warning signs are now becoming impossible to ignore. Andy Schectman has laid out a sequence of developments that point to an already forming physical shortage. One that is not being driven by retail speculation or cyclical demand, but by structural supply constraints tied directly to geopolitics, trade policy, and sovereign priorities. What makes this moment especially significant is that these pressures are emerging quietly, beneath the surface of largely unchanged headline prices, while the physical market itself is tightening at an accelerating pace. The silver market is not reacting yet, but the metal is moving. At the center of this situation is China's decision to restrict refined silver exports, combined with mounting bottlenecks in Switzerland's re-refining system and tariff-related disruptions across North America. These are not abstract policy choices. They are already translating into scarcity of investment-grade bars, rising premiums, and delayed availability for the very products most retail buyers depend on. What should concern long-term holders is not just that supply is tightening, but that it is doing so before mainstream capital has shown up, and before the broader market has adjusted its assumptions about availability. When physical metal becomes difficult to source at the wholesale level, the repricing process does not begin gradually, it begins abruptly. Before we go deeper into why this matters, especially for those holding physical silver, I want to pause here for a moment. If you are over 50, if you have spent decades building your savings, and if you either own silver or are considering adding it as a form of long-term protection, this channel is built for you. Take a second to subscribe, and leave a comment letting us know where you're watching from. Whether that's California, Florida, Texas, Arkansas, or somewhere outside the US. This is how we build a serious, informed community. And as we move forward, we will also connect Andy Schectman's physical market observations with Vince Lance's recent analysis, including what Goldman Sachs is now acknowledging about silver's changing behavior, shifting correlations, and the broader reset taking place across monetary metals.
Well, I mean, it was long overdue on so many levels for sure, but to me, what really has kind of exposed the general trend in the market, I guess you could say, are the amount of deliveries that we've seen on the COMEX. And, you know, one of the things that differentiates this market from any other that I've seen in 36 years is the amount of deliveries, both on the LBMA and on COMEX, where most of my career, less than 1% of contracts ever stood for delivery. And now we're seeing it over and over and over and over again. I mean, go back 13, 14 months when Trump won the election, it all started. But let's talk, for example, just last month, December, we saw 12,575 contracts, which was a new all-time high for the month of December of silver delivered, which is 62,875,000 ounces delivered into COMEX. Now, if a mint box of silver Maple Leafs or Eagles weighs 42 pounds, imagine what 62,875,000 ounces is all about. You're talking many semi-truck trailers worth. And much of this, not all of it, but much of it leaves the COMEX. So who is the entity or entities standing for delivery? The lack of journalistic integrity is shocking to me across the mainstream, as this has been going on not in an isolated one-off. This has been going on over and over and over again for going on 14 straight months. Now, here we are in January, month to date. We're looking at about 6 trading days so far, and we've already seen 5,451 gold contracts stand for delivery at 100 ounces apiece. That's 545,100 ounces of gold at times what, $4,400, you're into the billions of dollars 6 days in, and 6,321 silver contracts issued and stopped. In other words, someone took possession of it within the COMEX confines, moving it into an eligible category, which means it's not for sale. That's 31,605,000 ounces in 6 days. Now, this is what we have been seeing over and over and over and over again. And so to me, there's not much more you need to see. Much of everything else we see is noise. Of course, we can say, yes, the United States government created a critical mineral designation for silver. Certainly that's very bullish. And the same thing happened at the end of 23 with the European Union. They did the same thing. And then in retaliation to all of this, I guess you can say, everyone is focusing on the Chinese export ban or massive, I guess you could say, they are going to limit massively what leaves the country in terms of exports. All of the refineries that were exporting need to apply for a license out of Beijing, and the qualifications have become far more stringent. A much fewer set of companies will be allowed to export, and they have to be state sponsored. Well, the state doesn't want to issue silver because one thing that wasn't really caught as much, even by this industry, is the memorandum that came out in November where the Chinese said we are going to reprioritize exporting silver for national security, for domestic priorities. So in essence, you have a race going on, not by two brothers in 1980, the Hunt brothers, who realized there were more contracts than bars and tried to buy up all the contracts and stand for delivery. No, this is sovereign nations and I guess you could say prioritizing national security. And it's a different thing altogether. But I'll just simply say this, Charlotte. For years, and I've been saying with you on every show we've ever done, that the most well-informed, well-funded traders, and I'll highlight well-informed, that being the central banks, have been standing for delivery since 2020. Very unusual, because really no one ever stood for delivery. And this started to accelerate, but all along the United States was not part of this game. We were seeing it in the global south with the BRICS. And now all of a sudden we are seeing the most well-informed traders in North America stand for delivery in massive amounts and such that it's impossible for me to ignore. And I just wonder where all the experts, the so-called experts, are in the mainstream, the Jim Cramers of the world, who haven't even said, you know, it's interesting. Who's bringing in hundreds of billions of dollars of metal into the COMEX? It's as unusual as 4 feet of snow in Death Valley in July. That is how unusual these deliveries are. And to me, that's really what is setting the trend. When you talk about doré bars, China refines between 60 and 70% of all the world's unrefined silver. Much of it makes its way back out into the Western markets. Now, there's a rumor that I haven't been able to substantiate that is saying that as of the last few days, same thing is happening in Switzerland, where they need to reevaluate things and are asking the importers or all of the refineries to apply for some sort of a export license that could take between 4 and 6 weeks. And in other words, you're talking the majority of all of when China refines the doré and much of it will go to Switzerland because the bars that China puts out really don't meet Western standards. So, the Swiss refiners, and in particular, Pamp Swiss, Valcambi, Argo Herreras, and Metalor will take these bars and melt them down and re-refine them into kilos and 100-ounce bars that the West wants. Well, now all of a sudden you're putting a massive delay on that because things are changing very quickly. When the massive refining engine that is China stops or mitigates or really puts a wall up against exporting out into the market, you're starting to see the reverberations. And I'll tell you this, because of tariff threats, the 100-ounce bar and the kilo bar market in this country has become incredibly scarce with really high premiums because the threat of tariffs made it so that the large importers who bring these bars in were afraid to do so. So now you put in these export restrictions and problems with the refining in Switzerland. Nothing's coming in from the Royal Canadian Mint. They make 100-ounce bars because of the tariffs. And all of a sudden you have a market that is really, really short on investment grade bars in North America, and it's getting worse. And this is without very little mainstream participation at all. I think it's something to certainly be concerned about if you're looking for 100-ounce bars, or if you're running a company like mine. It's becoming very difficult to find what is normally the easiest product to get.
Building on Andy Schectman's point, what makes today's market different is that large amounts of real gold and silver are now being taken out of the COMEX and LBMA on a regular basis. In the past, futures contracts were mostly paper trades and almost never ended in physical delivery, but that has changed. Month after month, millions of ounces are being delivered and then moved out of sellable inventories, meaning the metal is no longer available to the market. This is not short-term speculation. It is long-term stockpiling, mainly by governments and large institutions that prefer to hold the metal itself rather than paper claims. Since 2020, this behavior has spread from gold into silver, at the same time that the US and EU have labeled silver a critical material. When governments secure a resource for strategic reasons, less of it reaches the open market, and seen this way, the very high gold-to-silver ratio reflects a market price that has not yet adjusted to tighter real-world supply. This is where Vince Lance's framework becomes especially useful, because it places these physical developments within a broader macro and market structure context. Lance argues that silver is now undergoing the same kind of beta reset that gold experienced over the last several years, where traditional correlations temporarily cease to function. In gold's case, rising prices occurred alongside higher real yields and a strong dollar, conditions that previously would have suppressed performance. That anomaly was not random. It reflected a structural repricing driven by monetary credibility concerns. According to Goldman Sachs, that same process is now beginning to express itself in silver.
The first and most important story: the Department of Justice is opening a criminal probe into Fed Chair Powell. Federal Reserve Chair Jerome Powell has been subpoenaed as the Justice Department opens a criminal probe into the Fed's headquarters renovation and related congressional testimony. Powell says the case is politically motivated and tied to monetary policy pressure. Markets reacted swiftly, with the dollar weakening, gold hitting records, and equities slipping. Very briefly, whether it has merit or not doesn't matter. It was done. And that shows to the rest of the world that the rule of law is bendable. By who, we don't know, but it's bendable. Over the weekend, we put out an analysis. We consider it must read if you're a silver person. We view the development as important. Goldman Sachs put out a report that closely mirrors what the bank wrote about gold in 2024. At that time, we had highlighted that gold's beta was changing and traditional correlations were temporarily suspended. Goldman stated then that the beta of gold is resetting higher. Quote, that language validated what we had already seen observing in 2023 and 24. The same framework is now being applied to silver. The old neo-Keynesian correlation structure is resetting at higher levels. Business as usual is no longer operating under those old assumptions. Structural change is now expressing itself in silver, just as it previously did in gold. We maintain our standard caveats and list them at the bottom of our analysis. The beta reset pattern is spreading, and monetary metals will never be viewed the same way again. Next up, the bullion banks are now talking about seasonality. Does gold have a January effect? January has historically been one of the strongest months of the year for gold. Over the past 10 years, approximately 70% of Januaries have closed in positive territory. This pattern remains consistent when measured across longer horizons of 15, 20, and 25 years, according to Deutsche Bank. Median returns in January over the past 25 years have been close to plus 3%, positioning January as the most reliably bullish month for gold on a seasonal basis. So that's it. Let's look at the markets. All right, I want to start with an actionable idea. Your action, not mine. I'm not telling you what to do. Common sense disclaimers. I said if we get above this all-time high, the wick, that we had a measured move. You know what? We do. I mean, it doesn't get any more perfect to have this conversation. Whether it happens or is profitable or not, we don't know. But this is the perfect moment to have this conversation. So here's how it works. When a market is in a trend and makes a new all-time high or low, and you have a rejection off the high, especially when I know who's selling it, and the market has a violent retracement, stabilizes, then works its way up in a semi-orderly fashion. Well, this is a cap, trade, and accumulate. When it gets above here, a lot of people are looking for, well, what's my next target? Now, your next target could be $144. Your next target could be $300. It could be $500. I don't care. Not everybody can stay that long-term focused all the time. Some people, need signposts along the way. And so this is another signpost. These have served us very well. Okay, hiccups. Above this high, you have depth equals distance. So you have 83.70. You go wick to wick on these, down to 70.30. So that's $13. That puts us at $96. Now, let me just back it off a little bit just to hedge my own enthusiasm. 83, we'll put a fine point on it for everyone that needs to be pinpoint on this. Above 83.75, 71.50, so let's call it 71.75, $12. 92.75. That's a target. Your targets on the upside, they can be based on Fibonacci, they can be based on Gann lines, they can be based on all kinds of things. They can be based on measured moves, 132%, 166%, what have you, right? But there are three ways to look at markets when we're at this stage. One is it just doesn't matter. We're going up, right? That's the I've been long and bullish forever mindset. They don't need to have this conversation. They're not watching this show, right? Then there's the people like Michael Oliver that say, look, I'm very convinced that it's going to anywhere from $150 to $300. And he has his indicators that say that. And those are things, and I have a similar mindset stemming from my understanding of critical minerals and what happens to them. And then there's people who want to think like us, but who have to get up and look at shit for a living and are trying to not react to it. And I'm saying to you that if you have nothing on, if you're not bullish or bearish, this is a measured move trade. The measured move trade is you get long, not you, me. I got long right here, right now. The problem with these trades is when do you get out if you're wrong? And the answer is it depends. Not technically. Fundamentally, one way to do this is you buy it right here, 84.04, bang. We've all bought it right here. And you stop yourself out on a tight stop if the market goes below 83.75 intraday. That's an aggressive stop loss. And that stop loss is something that you'll get out and get back in. You'll chop yourself up as we get in. That's the Paul Tudor Jones way. I'm in, I'm out, I'm in, I'm out, I'm in and out, I'm in. And then when it starts to work, he just triples down and it goes his way. That's the first way. Not everybody can watch a screen all day, right? I don't even do it anymore that way. Second way, as you say, if it settles below 83.75, I'm out. But what if it's early in the day and the market's below 83.75? Well, you say if it settles below 83.75, I'm out. Or if it trades and you find another price, the price might be 82.75. The price might be how much money you're comfortable losing on any one trade. But that's the way to do it.
The backdrop to this unfolding shift is deteriorating confidence in institutional stability, particularly in the United States. Recent developments surrounding the Federal Reserve, political pressure, and public disputes over credibility may or may not have legal merit, but markets respond to perception as much as reality. When the rule of law appears malleable, capital seeks assets that exist outside administrative discretion. The immediate reaction, dollar weakness, record gold prices, and brief equity volatility, is less important than the signal being sent to global capital allocators. Monetary metals benefit when trust erodes, and silver, as both a monetary and industrial asset, sits at a unique intersection of that dynamic. At the same time, silver's supply profile is fundamentally constrained in a way gold's is not. A majority of global silver production is a byproduct of mining for other metals, meaning output cannot be easily scaled in response to price. Industrial demand continues to expand through solar, electrification, and advanced battery technologies, while export restrictions and refining bottlenecks limit the flow of refined metal into Western markets. When supply is inelastic and demand is policy-driven, price discovery becomes compressed, often remaining dormant until inventories reach a threshold where delivery obligations collide with availability. For investors, the key takeaway is not a specific price target, but a recognition that the silver market is being redefined by forces outside traditional technical and cyclical analysis. Physical tightness, sovereign accumulation, regulatory designation, and changing institutional behavior collectively suggest that silver is transitioning from a marginal monetary metal to a strategically contested resource. In such environments, volatility is not a sign of instability. It is a symptom of repricing. Those waiting for confirmation from mainstream narratives often discover that the adjustment has already occurred. As always, none of this is financial advice, but it is a framework for understanding what is unfolding beneath the surface of the paper markets. If you found this analysis useful, make sure you're subscribed, share it with someone who owns physical metals, and leave a comment below with your thoughts and where you're watching from. This channel exists to cut through noise and focus on structure, incentives, and reality. Thank you for spending your time with us, and I'll see you in the next video.